Our topic is different risk in insurance, and we can discuss about the risk insurance. Risk insurance shall involve assessing the price to be paid to insurance policy holders who have suffered from the loss that occurred to them, which is covered by the policy. It involves various type of risk such as theft, loss, or damage of property, or also may involve someone being injured. There is a chance that something unexpected or harmful that may happen at any point in time. We can discuss about various type of risk insurance. There are mainly 8 types of risk that include pure risk, speculative risk, financial risk, non-financial risk, particular risk, fundamental risk, static risk, and dynamic risk. Next will be taken by Ashley.
Okay, as we amply mentioned about the different types of risk in insurance, we have to go too deep to know more about the insurance. First, risk in insurance is a poor risk. It is a risk that is refers to a situation where it is certain that the outcome due to certain loss of a person only, or maximum when it leads to the condition of break even to that particular person, or it can never cause any profit to that person. And considering an example of the poor risk, it involves the possibility of the damage of the house due to the natural calamities. In case of any natural calamities occurring, it will damage the house of the person and its household items, or it will not affect the person's home and household items. Still, this natural calamity will not give any profit or gain to that particular person. So, this will fall under the poor risk, and these risks are insurable. Ranjit, next slide. The second risk in insurance is a speculative risk. The speculative risk is actually the risk which refers to a situation where the direction of the particular outcome is not specific, it is not clear. That means it could lead to a condition of any loss or profit or any break even. And the speculative risks are generally which are not insurable. An example of the speculative risk is including the purchase of the shares of a company by a particular person. Now, the prices of the shares can go in any direction, and a person can make either loss, profit, or no profit at the time of the sale of those shares. So, this will fall under the speculative risk.
Then the financial risk. Uh, as we all know, financial risk refers to the danger in which the outcome of an event is measurable in terms of money. Any loss that could occur due to the risk can be measured by concerned person in monetary value. It is known as financial risk. An example of financial risk includes a loss to the goods in the warehouse of a company due to the fire. These risks are insurable and are generally the main subjects of insurance. The other examples are market value risk, credit risk, and liquidity risk. Then the non-financial risk. Non-financial risk refers to the risk in which the outcome of an event is not measurable in terms of money. That is, any loss that could occur due to the risk cannot be measured by the concerned person in terms of monetary values. An example of the non-financial risk include the risk of poor selection of the brand while purchasing mobile phone. These risks are uninsurable since they cannot be measured. Others risks are model risk, operational risk, settlement risk, accounting risk, etc. Jacob?
Next topic is particular risk. Particular risk refers to a risk which arises mainly because of the actions or the interventions of the individual or the group of some individuals. So the origin of the particular risk by individual level and impact of the same is felt at a localized level. An example of a specific changes includes an accident on the bus. These risks are the insurable and are generally the main subjects of the insurance. The next topic is fundamental risk. Fundamental risk refers to a risk which arises due to the causes which are not under the control of any person. So it is said that the fundamental risk is impersonal in its origin and the consequences. The impact of this risk is essentially on the group. Either it affects a large population. The fundamental risk includes risk on the group by events such as natural calamity, economic slowdown, etc. These risks are insurable.
Next, we can listen to the statistics. The static risk refers to the risk which remains constant over the period and is generally not affected by the business environment. This risk arises from human mistakes or action of nature. An example of static risk includes the embezzlement of fund in a company by its employee. It's are generally easily insurable as they are easy to measure. Digit, next slide. So we can see about the dynamic risk. Dynamic risk refers to the risk which arises when there are any changes in the economy. These risks generally too easy to predict. These changes might bring financial loss to the members of the economy. An example of dynamic risk includes the changes in the economy, income of a person in an economy, their taste, preference, etc. They are generally not easily insurable. Next, we can move to the conclusion. As my friends already talks about the risk involved in insurance, thus the insurance or the risk in the insurance are the chance of unexpected events will occur, which could the loss of to the person and its property. Most of the risk are nowadays insurable by insurance companies. These companies calculate the probability of the event and their impact and then calculate the premium accordingly. Thank you. That's all about the